So we want to bring you in to talk about Chinese stocks in particular. We saw some earnings and we have some details, and our panel is ready. Henry Greene, investment strategist, Crane Shares, and Olivier Blanchard, research director at Futurum. Thank you both for being with us. Henry, I'll start with you. When I look at JD.com and we think about the growth that they saw, the number of users, it was a lot of, by the way, we heard from JD, we heard from Tencent, both of those did beat the street. Alibaba's in the midst of a revamp. There's been a lot of good things happening. I know JD came under some pressure because of the profit numbers, but what's going on here in your opinion here, Henry?
Yeah, Nicole, thank you for having me, first of all. Yeah, I think that JD has been under pressure. Well, its margins have been really under pressure. We see the margin is down to about, I think, 1 to 2% net margin from Q3 of last year, when it was higher at 4 to 5. JD has historically had some of the lowest margins in the China e-commerce space, but that margins just keep going even lower because of the massive subsidies they've been putting into their instant commerce business, which has really taken off, and it's gotten them more revenue, as we're seeing in their revenue beat, but it continues to be very costly for the company. So it'll be very interesting how management is going to deal with this going forward, and how they're going to kind of get back to the margins as they were very slim, you know. And I think JD has underperformed in this space within our KWEB ETF. That's KWEB, China Internet ETF. We see JD as one of the lowest performers year to date. And that's owing to anxiety over these costly subsidies. But we did see them beat estimates on revenue. We did see them beat on net margin this quarter.
Look, JD had a lot of good news. I mean, they're reaching 700 million users. Retail growth has been holding firm. The profit did come under pressure. A lot of that had to do with some of the food delivery. But at this point, it really isn't a side bet. They're talking about converting users at nearly 50%. That's a positive when it comes to JD.com. What are some of your thoughts, Olivier?
Yeah, so I agree with everything Henry said. And to your point, it was kind of a mixed bag, right? It's not just all bad news. They beat expectations. They had a good quarter. But what we're seeing across the entire sector, it's not just them. It's also Alibaba, it's Pinduoduo. The Chinese retailers are attracting their customers or retaining their customer interactions by essentially buying it through rebates, through low pricing, commodity pricing. And so that, to me, reflects two things. One, there's some uncertainty in the market on the consumer side, on the demand side, right, where people don't really know what they should spend their money on. They're being a little cautious, a little shy. And so these retailers have to go out and find that business. And we're also seeing that in some of the diversification that we're seeing with JD, which seems just a little bit nervous. They're trying a lot of different things to see what will stick, which isn't a bad strategy in and of itself. But when you look at the whole picture, it looks a little bit nervous. It's like they're looking for the next revenue streams because their big revenue generators right now aren't necessarily growing at the rate that they would. So they're trying out and feeling the waters. So essentially, you're seeing that, but it's not just JD. It's the entire industry.
So the question is, I mean, some people love to invest in Chinese stocks and some people do Asia ex-China. Assuming people love these names and they think there's potential growth for Chinese markets here. Henry, what do you think when you look at these names, Tencent, JD, Alibaba, and Pinduoduo? Is one of them more of a favorite in your book, and if so, why?
I'm gonna have to say, you know, we like the basket, you know, given that we run KWEB, the KWEB ETF. But if I had to pick one right now, I think Alibaba has had the most impressive performance year to date. I think that they're number one when it comes to cloud, when it comes to AI. They have their QN model, which is one of the most popular models in China. Actually, Airbnb, the US company, just said that they're using Alibaba's QN model, among others, because of how modular it is and how tactical they can be with it. So that's really interesting on the LLM AI side. And now Alibaba's different, right? Because they have AI JD doesn't really do that. Doesn't do that. Alibaba is very diversified, so they can kind of lean on that cloud growth. Because yeah, we've seen the consumers coming back a little bit in China, pretty steadily, but it's still got a long way to go. We still need to return to that, having the whole pie growing. And I think all of these price wars in instant commerce and all that competition there is because a lot of these companies still are competing for the same wallets. We don't have new wallets coming into the e-commerce space. We think we could soon again, but we still need for that to happen. And when that happens, it's going to be a very positive story for almost all these names. We saw Tencent, Tencent is really geared toward needs that overall consumer to be doing very well, and they just had positive earnings. So maybe that's a sign of things to come. But right now, given all of this focus on instant delivery, it's really because they're competing for the same group of wallets.
Yeah, and Olivier, I'll turn it over to you. I mean, obviously the Alibaba investment in AI app, which is now trying to resemble more like ChatGPT, Q1 is what he's talking about and being utilized. That's good news for Alibaba. What about a name like Tencent? Was there something within the earnings there that stood out to you? And which name is your favorite of the four?
Yeah. So I mean, I agree with Henry. Alibaba is just kind of a monster. Let Alibaba cook. They're going in the right direction. They're doing all the right things. But to your point, Tencent is really interesting. It's they just had a 43% surge in international gaming in the last quarter. Their market valuation in the past year has gone up 280 billion. Their AI enhanced or AI enabled advertising targeting saw an increase of 21% in the last quarter. So they're doing a lot of the right things. And what's interesting about them is, unlike every other tech company of its type, it hasn't invested heavily in AI yet, or at least not in the infrastructure piece. It's working more in integration, which I think is kind of a sly way of getting into the AI business without necessarily moving too fast, without necessarily committing too many resources to it, but essentially integrating AI quickly and intelligently into revenue channels that are already mature, that are already working. So it's an interesting experiment, and it kind of goes against what everybody else is doing in the industry, both in China and the United States. So they're a really interesting company to watch.
Thank you, Olivier Blanchard, and also Henry Greene. Thank you for being with us.